Welcome. This is Opening Bid on Yahoo Finance. I'm Julie Hyman. I'm in for Brian Sazi. I'm excited about our guest today, someone who is as comfortable on Wall Street as he is in the political realm. That is Ralph Schlosstein. He is Chairman Emeritus of Evercore ISI. He was a co-founder of BlackRock, and he is joining me right now. Ralph, welcome. Thanks so much for joining us.
Thanks so much, Julie. It's a real pleasure to be with you.
So I want to start more in the business realm, and then we'll sort of migrate over to politics, because we are, of course, coming off of a jobs report last week that once again sort of reinforced some of the jitters that are out there about what's going on in the labor market and in the broader economy. Now, for folks who are watching and listening, you actually are based most of the time in London these days. So it must be interesting having that perspective on what's going on in the U.S. But I am curious what your thoughts are on the whole question of soft landing and where we stand right now.
Well, I think so far the evidence both on the inflation front coming down and on the jobs front weakening, but not weakening so much that we're concerned about recession, would suggest that we have a pretty good shot at a soft landing. I think the next few months of Fed policy particularly will be important to do our very best to ensure that soft landing doesn't bump 2 or 3 times. We've all been on planes where that's happened. And I think the interesting thing about the jobs report on Friday was that it really didn't provide enough evidence to push you toward 25 definitively or 50 definitively. So I think this is going to be a very interesting Fed meeting where there'll be a lot of back and forth discussion. I think the inflation data that comes out over the next few days could provide a little more impetus in the direction of 50, which I happen to kind of marginally favor, because I think the balance of risks has shifted now away from inflation reaccelerating or being too high and more toward employment slowing too much.
Do you think the Fed is late to the game here? There are certainly some analysts and strategists and economists who think that the Fed should have been cutting already. Does 50 kind of take care of that?
I think the 50 would be a catch-up and in effect a little bit of a safety net to ensure that they aren't behind the game. I also don't really, I think if you do 25 now and see a little bit more weakening and then 50, it has more of an element of not panic, but concern. Whereas if you start with 50 and then say you're sort of catching up to getting a little bit closer to neutral, and then we'll watch from then on to see whether we continue with 25s or 50s, I think is a better plan in my view.
Now, in the conversations that you have with business leaders, because I know you have a lot of those conversations, how are they feeling about the business environment, about the economy right now, especially as we are going into a presidential election here in the U.S.? Sort of, for lack of a better word, what's the vibe that's out there?
Well, the vibe is that things are pretty good in their own businesses, yet they all worry a little bit that the Fed is a little bit behind the 8 ball and that the economy might weaken. So I think you've got a period of time when, even just leaving aside the presidential election, which obviously injects another layer of uncertainty, but if you look solely at the economic data without regard to the fact that this is a year divisible by 4 and a presidential election, there's just a little bit more uncertainty out there right now. What's the Fed going to do? Is inflation really getting under control? Are we going to see a soft landing, or are we going to see I don't think anybody thinks we're going to see a severe recession, but a modest recession. So there's just a lot of uncertainty right now.
And how is that informing what's happening sort of in the realm of M&A, deal flow generally, the IPO pipeline, et cetera? We definitely have not seen a flood of that kind of activity this year. What is it? The interest rate cuts that are going to change that? Do we have to get past the election? What's going to sort of creak that door open again?
I think putting behind us this period of modest economic uncertainty, and probably putting behind us the election as well. Uncertainty is the enemy of M&A, and particularly what I just described, where people feel pretty knowledgeable and confident about their own businesses and a little less confident about everybody else's business. That tends to constipate M&A activity. On the other hand, I would say that we at Evercore, we look at various indicators of activity, and the most forward-looking that's tangible is what we call conflict clearances. A client calls up and says, we're thinking about doing this, and we check to see if we have any legal conflicts. A less forward-looking one would be engagement letters signed, and a least forward-looking would be the actual backlog itself. So, and then most forward-looking of all, but not quantitative, is so-and-so has called us and wants to talk to us about this. All of those forward-looking indicators are up quite a bit from where they were last year. Getting from engagement letter and discussion to transaction and closing is just harder right now. And uncertainty is the element that makes it harder to go from engagement letter to transaction. And some of the regulatory issues have made it a little bit more attenuated process to go from announcement to closing.
Right. I want to kind of zoom in on that aspect for a minute, Ralph, because the regulatory environment, we've seen a quite active regulatory environment in terms of blockage of deals that had already been agreed to, a lot of noise around potential deals. If you're looking at sort of the percentages of how much that's a factor versus, say, economic uncertainty or some of the other things you were talking about, how heavy a weighting is that right now?
Well, I think I said in 2017 that I think the hardest job in America right now in the financial world was to be an antitrust lawyer, because antitrust was not governed by the law, but it was governed by whether the president liked you or not. So they challenged the AT&T Time Warner transaction, where there was absolutely no basis in law for challenging that. I think but what I did say is, at the end of the day, when President Biden came in, that antitrust, ultimately, for antitrust policy to change dramatically, you need a change in law. We're not going to have a change in law. So no question, the FTC and the Justice Department have been somewhat more aggressive than under President Biden than in the previous administration. In some cases, those actions have been supported by the law. In many of those cases, they've been on the edge of the law or beyond, and they've actually lost a fair number of cases in court. So I do believe that if two companies want to come together and the law supports the fact that it's not in violation of antitrust law, that they ultimately will prevail in the courts. It's a little longer process. It's painful, but there are a fair number of examples where that has happened,
Yeah.
and that also has a somewhat you know, dampening effect on the aggressiveness of the regulators, because nobody likes to go in and lose in court time and time again.
It hasn't seemed like there's that much dampening, because certainly the regulators have still been pretty active. It's interesting to imagine how much more active they would have been had they gotten those victories in court you're referring to. This seems like a good time to segue over to the political side of things. There was a recent report by Bloomberg that Wall Street donors have been pushing Kamala Harris to replace some of the top regulators of Wall Street. People like Lena Khan of the FTC, Gary Gensler of the SEC. Do you think that would be a good idea?
I think it's almost ridiculously premature to have a discussion like that. And by the way, I don't believe that any supporter or donor would make that request as a condition of their support or contribution to the campaign. And if someone was foolish enough to make that request or conditioning of their donation, I am sure the campaign would quickly
push back against. Yeah. Ralph, hold that thought. I do want to get more from you on this, but we have to take just a very quick break.
Great.
We're back on Opening Bid from Yahoo Finance. I'm here with Ralph Schlosstein. He is the Chairman Emeritus of Evercore ISI. By the way, I'm Julie Hyman in for Brian Sazi. We're just talking about regulation and the reports that there had been some perhaps donors who were asking Kamala Harris to consider replacing some of the regulators if she does indeed win the presidency. Ralph, you were just saying, even if there is that chatter, wouldn't necessarily be conditioned. Their support for her would not be conditioned upon that. But let's talk about another topic that is near and dear to many business leaders' hearts, and that is tax policy. Right? We've heard former President Donald Trump saying that he would certainly extend corporate tax cuts. He might even bring them even lower to a rate of 15%. Kamala Harris has talked about raising the corporate tax rate to 28% from 21%. There's what the candidates say. There's what is maybe likely to happen. How are you thinking about those issues? And again, what kind of conversations are you having about them?
I think the real issue for corporate tax rates in the United States is that our corporate tax rate has to be competitive with our principal competitors globally. And, you know, our competitors are kind of all over the lot. There are a handful of relatively small, low tax sanctuaries that are in the 15% kind of range. But the vast majority of corporate taxation is in the twos, sort of low 20s to high 20s. So I don't think there's any magic number between where we are today and where Vice President Harris outlined as her objective. And my guess is that if she were elected, there's going to be a major discussion about taxes in 2025 because, all of the Trump tax cuts expire at the end of 2025. And, some of those, the individual cuts below people who earn $400,000. I think there's unanimity that those should be extended. Biden and Harris have supported that. President Trump has supported the extension of all of his tax cuts, plus adding to them. And so there's going to be a massive discussion. Who's president will have a huge effect on that. And, I will say that corporate tax rates, there is kind of a linear effect arrangement between them and the stock market. Because if you think about if a company earns $1, if they have 21% corporate tax rate, the shareholders get to keep 79 cents, without regard to state taxation at the moment. Obviously, that is some. If it's 25%, they get to keep 75 cents. The difference in that is roughly 5 percentage points. If it's 28, it's 72. The difference between those two is roughly 10 percentage points. So if earnings are 5% or 10% lower, it's logical that will have an effect on the aggregate value of equities in total. So this is not an unimportant question for the stock market. I remember in 2016, I happened to be I think I was in France, and Ed Hyman, who founded ISI, and he was the night of the election, and he called me at like 5 a.m. in France, and when looked like Trump was going to win, and S&P futures were down 1,000 points, and he said, "I'm speaking to a couple of to a bunch of institutional investors. What should I say?" And I said to him, and it turned out I'm telling you this because I actually turned out to be right for once. I said to him, the S&P futures are down 1,000 points right now. Tell them that you think by the end of the day, the S&P will be flat to up a little bit, because what has Trump really said? He said he's going to be for a very stimulative fiscal policy, and he's going to cut corporate taxes. Both of those things are huge for the stock market.
Well, Ralph, that brings up the question of what you think is going to happen this time in terms of stock reaction in this what seems like a pretty binary election, right? But what do you think is the capacity for stocks to increase under each scenario?
Well, I think honestly, now I will clearly identify myself as a Democrat,
right?
So you take this with a grain of salt. I do think there are elements of, President Trump's policy, most specifically the tariffs, which are very bad for the market. They're inflationary, and they also presage a sort of protectionist policy, which has always been very, very bad for the markets. I actually think that Harris administration would have a relatively modest effect on the markets initially. There would be some effect depending upon how this corporate tax extension issue gets decided in 2025. My guess is if she's elected that there will be some modest increase in the corporate tax rate, and there'll be some compromise, because I suspect we'll not have a Democratic House, Senate, and presidency. So I think there's much greater volatility, beta risk in the Trump policies than there is in the Harris policies.
Right. And the Democrat disclaimer is important to be sure on that front. One more tax question, which is about the unrealized capital gains, the proposal that she has made that would affect folks who are worth at least $100 million. Now, this has caused a fair bit of discussion and consternation in some quarters, and some claims that it could choke off investment if that were to take effect. What do you think? And again, I understand your particular political lens, but do you think that the alarm over that potential policy is warranted?
I think the alarm over that policy is warranted, but not for the reason that you articulated. I think the reason that a policy like that is alarming is that it's ridiculously complicated to administer, and therefore ridiculously amenable to gaming. And so, obviously, if it's a stock, you can see if it's a publicly traded stock. But for other assets, there's going to be, it's a tax lawyer's and accountant's dream. I happen to be, notwithstanding the fact, or maybe this makes me, I'm very unusual in the financial community. I happen to believe that I don't buy this argument that people don't invest because capital gains tax rates are too high. What are they going to do with their money? Stuff it in a pillow?
Right.
And so I'm one of these people who believes that the massive differential that we have between capital gains and ordinary income rates is probably certainly the principal policy decision that has widened the wealth gap in this country, and which I think is potentially a corrosive thing for capitalism in our society. So I'm one of the very small number of people in the financial community who, if you said there's no differential between capital gains and ordinary income, wouldn't scream about that.
Yeah, rare indeed. Just quickly, Ralph, lastly, I want to ask you more of a personal question, which is, as I mentioned in the beginning, you're living in London now. That's because your wife, Jane Hartley, is the U.S. ambassador to the UK. You've stepped back, obviously, from day-to-day running of Evercore ISI. How is it? What is it like to, you're living there. She is still working quite actively. I'm just curious how it is.
Well, whenever I get asked this question, I always say I have the perfect 73-year-old guy's life. I have 4 part-time jobs. I'm chairman emeritus of Evercore. I always say without any merit. I'm your advisor to Warburg Pincus, the private equity firm. I'm running a family office with my son, who's doing that full time, and I'm doing it part time. And I'm a trailing spouse to my wife in London, and I spend half my time in London and half my time in New York. So what could be better than that?
It sounds pretty fantastic. I'm not going to lie. Ralph Schlosstein, thank you so much for joining us, talking about everything from what's going on in the markets to potential soft landing, deal flow, politics. We covered a lot of ground here, and I know you're going to be setting your alarm for the replay of the debate later this week.
Thanks very much, Julie. It's always a pleasure to be with you. It really is.
Really appreciate it. Well, Brian Sozzi will be back, I believe, next week here on Opening Bid. In the meantime, I've been Julie Hyman. Really appreciate you listening and watching.